How much do you actually need to retire in Canada? Ask 10 people and you'll get 10 different answers. Some will say $1 million, others will say you'll be fine on much less. The truth is, there's no one-size-fits-all number, but there is a way to calculate the right number for you. If you're relying on guesswork, you could end up oversaving and working longer than necessary. Or worse, underestimating your needs and running out of money when it matters the most. In this video, I'm going to walk you through a clear and realistic framework for figuring out your retirement number based on your income needs, expected government benefits, taxes, inflation, and how long your money needs to last. Hi, if you're new here, my name is George McConaughey, and I'm a portfolio manager at Novus Pro of Raymond James. I help Canadians make informed financial decisions, minimize tax exposure, and build sustainable retirement plans based on real numbers, not guesswork. Let's walk through how much you actually need to retire and how to create a plan that supports your lifestyle for the long run. Step number 1, understand your lifestyle needs in retirement. The most important starting point in retirement planning isn't your investment strategy or account structure. It's your lifestyle. Specifically, how much will it cost you to live the life you want after you stop working? Too often, people begin with a number like $1 million and try to work backwards. But the right approach is to start with the outcome. What do you want your retirement to look like? And how much income will it take to support that? That number is different for everyone. Some retirees want to travel regularly, help their children financially, or split time between 2 properties. Others prefer a slower pace, lower overhead, and more time spent at home or in their community. There is no right or wrong approach. It just depends on what's important to you. Start with your monthly spending. The best way to estimate your retirement lifestyle cost is to look at what you're spending today. Then make adjustments for how things will change. Once you're no longer working, some costs may go down, commuting and work-related expenses, mortgage payments if the home is paid off, support for your adult children or dependents, but others may go up, travel and leisure in the early years, hobby, projects, volunteering, medical expenses and personal care in later years. Many Canadians find that their essential costs stay relatively stable, but discretionary spending changes as their lifestyle evolves. As a general rule, you can expect to need about 60 to 75% of your current after-tax income to maintain your lifestyle in retirement. So if your household currently lives on $90,000 net per year, you might plan for $55,000 to $70,000 annually in retirement. But that's just a starting point. Rethinking retirement in phases. Retirement isn't a single 30-year stretch of flat spending. It's dynamic. Your lifestyle and spending habits will change as you move through different phases of life. Instead of using outdated models like go, slow go, and no go, we use a more modern and realistic framework based on behavior and health. Phase 1, front-loaded retirement. This is the first 5 to 10 years after you're retired. You've left work behind, you're healthy, and you finally have time. This is when most retirees spend the most on travel, home improvements, hobbies, family events, and experiences they didn't have time for while working. It's exciting, but it comes with a higher price tag. Phase 2, stabilized retirement. As you settle into a new rhythm, your spending becomes more predictable. This is when you find your routine, daily activities, modest travel, community involvement, expenses level out. This is often the longest and most stable phase of retirement. Phase 3, health-conscious retirement. In later years, your priorities shift. You may travel less and spend more time at home. Health-related expenses such as prescriptions, mobility aids, or home care services may increase. Your discretionary spending may fall, but your essential and healthcare related costs could rise. This model helps you avoid the mistake of assuming that retirement spending stays flat for 30 years. It doesn't. Planning for these shifts gives you better cash flow control and helps you make smarter withdrawal decisions. Don't ignore inflation. Something else many people forget to factor in is inflation. It doesn't seem like a big deal year to year, but over 25 or 30 years, it can drastically change the purchasing power of your money. Even a modest 2.5% inflation rate can cut the real value of your income in half over a typical retirement period. For example, if you need $60,000 per year today to maintain your lifestyle, you'll need over $100,000 per year in your late 80s to afford the same standard of living. That's inflation. That's why your plan needs to account for rising costs, not just fixed income needs. The real goal of step one, before you start thinking about investment returns, RRSP conversions, or tax strategies, the real first step is clarity. How much will your retirement lifestyle cost month by month, year by year? Once you define that, you can begin building a strategy to support it. That includes projecting your government benefits, identifying your income gap, and determining how much you'll need to withdraw from your own savings. And that's exactly what we'll look at next. What can you expect from CPP, OAS, and how much those government benefits fit into your retirement income plan? Step two, factor in government benefits. Once you've estimated your lifestyle expenses in retirement, the next step is to figure out how much of that income will already be covered by government benefits. In Canada, there are two core retirement income programs available to most people. CPP, called the Canada Pension Plan, OAS, Old Age Security. Understanding what these programs offer and how much you can realistically expect to receive is key to knowing much of your income will need to come from personal savings like your RSPs, TFSAs, or corporate assets. CPP, what you need to know, CPP is a contributory program. That means you receive it based on how much you contributed during your working years and for how long. It's not automatic. You have to apply for it. You can start receiving CPP as early as age 60 or delay it as late as age 70. Here are a few important facts. The standard age to begin CPP is 65. If you start early, so before 65, your monthly benefit is reduced by 0.6% for each month before your 65th birthday. That's a 36% reduction if you start at age 60. If you delay CPP past 65, your benefit increases by 0.7% per month. That's a 42% increase if you wait until age 70. As of 2024, the maximum monthly CPP benefit at age 65 is about $1,364 per month, or $16,370 per year. But very few Canadians actually receive the maximum benefit because reaching it requires 39 years of maximum contributions at or near the maximum earnings threshold during most of your working life. The average CPP benefit for new recipients is closer to $760 per month, or just over $9,000 per year. OAS, what you need to know. OAS is not based on your work history or contributions. It's based on how long you've lived in Canada after age 18. To receive the full OAS benefit, you must have lived in Canada for at least 40 years after age 18. If you've lived in Canada here for less time, you may receive a partial benefit. You can begin receiving OAS at age 65 or delay it up to age 70 like CPP. Delaying OAS increases the monthly benefit by 0.6% per month, up to 36% more if you wait until age 70. As of 2024, the maximum OAS benefit is approximately $713 per month, or about $8,556 per year. One important note is OAS is subject to a clawback. If your net income exceeds approximately $90,000, the government begins to reduce your OAS benefit. Once your income reaches around $148,000 per year, your OAS is fully clawed back for that year. How these benefits fit into your plan when you combine CPP and OAS, many Canadians can expect between $17,000 and $25,000 per year in retirement income from the government. For a couple, that could be $35,000 to $50,000 per year if both are receiving full or near full benefits. Now go back to the number you estimated in step one. Let's say you determined that you need $70,000 per year to maintain your lifestyle. If CPP and OAS are expected to provide $24,000 of that, leaves an income gap of $46,000 per year. That gap is what your investments and savings will need to cover, ideally in a tax-efficient way, which we'll address in upcoming steps. It's worth noting that you don't have to take CPP and OAS as soon as you're eligible. In fact, delaying these benefits can make a lot of sense in the right circumstances, which are you have other income sources to rely on, RSPs, corporate savings, non-registered assets. You're in good health and expect to live into your 80s or 90s. You want to reduce your RRSP withdrawals in your 70s to avoid higher tax brackets or OAS clawbacks. Waiting a few extra years can significantly increase your guaranteed inflation-indexed income later in life, which can reduce reliance on your portfolio and help protect your long-term cash flow. CPP and OAS are valuable income sources, but they rarely cover 100% of what most Canadians need in retirement. That's why the next step is to calculate your retirement income gap and begin designing a strategy to withdraw from your investments like RSPs, TFSAs, and corporate accounts in a way that fills the gap while minimizing your tax burden and exposure over time. We'll start by looking at the most common retirement asset for most Canadians, the RSP, and why waiting too long to use it can create problems down the road. Step 3, start drawing from your RSPs early. Strategically, if you're like most Canadians, your RSP has likely been your primary retirement savings vehicle for decades, and that makes sense. It's tax deductible when you contribute to it. It grows tax deferred, and for many people, it's been a reliable strategy for building long-term wealth. But once you retire, the conversation changes completely, because now it's about drawing from your RSP in a way that minimizes taxes and preserves income flexibility. This is where many people go wrong. They wait until the government forces them to convert their RSP into a RRIF, which is a RIF, at age 71, and only then begin withdrawing. At that point, your account has often grown to the point where the mandatory withdrawals push you into a higher tax bracket, trigger the OAS clawback, and limit your ability to manage your taxable income. Let's walk through how to avoid that. The problem with delaying RSP withdrawals. By the end of the year you turn 71, you must convert your RSP to a RIF, Registered Retirement Income Fund. Starting in the following year, age 72, you're required to take out a minimum percentage of the account balance each year, which is calculated on December 31st. And that percentage increases as you age. Now imagine you've left your RSP untouched until age 72. Let's say your balance has grown to dollars. You now have to withdraw $44,000 at age 72. More each year after that. And every dollar is fully taxable. If you also have CPP and OAS and possibly pension or corporate income, your total taxable income may now be well over $90,000 per year, putting you in a higher tax bracket and potentially triggering an OAS clawback. What's the alternative? If you start drawing from your RRSP early in a controlled and strategic way, you can smooth out your taxable income over time. Here's what that could look like. You retire at age 60, you delay CPP and OAS until 67 or 70. In the meantime, you withdraw $30,000 to $40,000 per year from your RSP. You stay in a low tax bracket and you reduce your RSP balance before it turns into a RIF. This approach allows you to keep your taxable income manageable, reduce future RRSP withdrawal obligations, potentially avoid OAS clawback entirely, shift money into other more flexible accounts like your TFSA if it's not maxed out. But what about the taxes? Yes, you will pay tax on RRSP withdrawals, but the goal is to control how much and when. Would you rather pay 20% tax on $30,000 now or 33% on $60,000 later when you have fewer options? Early withdrawals give you the chance to use lower marginal tax brackets before they disappear. You're effectively prepaying tax at a lower rate and getting ahead of what could become a tax time bomb later. Your RSP isn't something to leave until the last minute. It's a powerful retirement tool, but only if you integrate it into a year-by-year plan that considers your other income sources, your tax brackets, and how your spending needs evolve over time. In the next step, we'll look at your TFSA as an account most Canadians understand from a savings perspective, but often underutilized when it comes to retirement income strategy. Step 4, use your TFSA strategically. The TFSA, or tax-free savings account, is one of the most misunderstood tools in Canadian retirement planning. A lot of people hear the word savings and assume it's only meant for cash or short-term goals. But in reality, your TFSA can play a major role in building tax-efficient income and increasing flexibility throughout your retirement. Used the right way, it's one of the most powerful planning tools available, especially when paired with RSPs, RSP drawdowns, government benefits, and corporate income strategies. Let's break down how your TFSA can fit into your long-term plan. Why the TFSA matters more in retirement than you might think. The TFSA offers 3 key advantages that make it ideal for retirement income planning. 1, tax-free growth. Investments inside a TFSA grow completely tax-free. 2, tax-free withdrawals. Every dollar you withdraw is yours to keep. It doesn't affect your taxable income. 3, no impact on government benefits. TFSA income does not count toward income thresholds that trigger things like OAS, clawback. That means your TFSA gives you the rare ability to generate income in retirement without increasing your tax bill. No other account offers that kind of flexibility. Strategic uses of your TFSA in retirement. Let's look at 3 ways you can use your TFSA more strategically. Number 1, control your tax bracket. Let's say you're already drawing from your RRSP and you're close to an OAS clawback threshold. You want to cover a one-time expense, a new car, a renovation, or a major family gift. Instead of pulling from your RRSP and risk jumping into your taxable income, you can pull from your TFSA tax-free and avoid moving into a higher bracket. The same applies to years when you already have elevated income from capital gains, property sales, or dividends. Number 2, supplement income during the gap years. If you retire at 60 but delay CPP and OAS until 70, you'll likely have a 10-year period where you'll need to generate your own income. Using your TFSA to supplement modest RSP withdrawals can help you avoid overusing your RSP too early, stay in a low tax bracket, extend the life of your registered savings, reposition money into the TFSA over time. Another overlooked strategy is to gradually move taxable funds into your TFSA. This might mean withdrawing from your RSP in early retirement, paying the tax at a lower rate, then contributing those funds to your TFSA over time. Now that money grows and comes out tax-free forever, and that's a long time. It's a simple repositioning move, but over time, it can save you thousands in tax and give you more flexibility as you age. What can you invest in within a TFSA? Remember, your TFSA is not an investment itself. It's an account, like a garage. What you hold inside it determines how much it grows. You can hold mutual funds, stocks and ETFs, bonds, GICs, even high interest savings. In retirement, your TFSA should be treated like a core investment account. If it's holding only cash or GICs, you don't need that liquidity. It may not be aligned with your long-term plan. The key is to align your TFSA investment mix with your risk tolerance, income needs, time horizon, just like any other investment account. Most Canadians think of their TFSA as a side account, but in retirement, it becomes a critical tax management tool, a way to fund your lifestyle, cover one-time costs, and manage your marginal tax rate without sacrificing your long-term plan. Used properly, it's not just a savings vehicle. It's a strategic lever that can extend the life of your portfolio and help you retire with more control and less stress. Now, while registered plans like RRSPs and TFSAs often get the spotlight, there's another layer to the plan that's just as important: your non-registered and corporate assets. Step 5, use non-registered and corporate accounts wisely. By this point in the plan, you've figured out your retirement lifestyle cost. Step 1. How much is covered by CPP and OAS? Step 2. How to draw down RSPs strategically? Step 3. And how to use your TFSA to reduce taxes and add flexibility? Step 4. But what if you have more savings than just registered accounts? Many Canadians also hold non-registered investment accounts, personal or joint, corporate accounts from retained earnings or holding companies. These accounts give you more flexibility, but also come with tax complexities that need to be managed carefully. How non-registered accounts are taxed. Unlike your TFSA or RSP, income earned inside a non-registered account is taxable every year. You might be taxed on interest income, taxed at your full marginal rate. Eligible dividends taxed more favorably due to the dividend tax credit. Capital gains, only 50% of the gain is taxable when realized. The benefit of non-registered accounts is that you can withdraw money anytime without triggering withholding taxes. Access principal without generating income. Strategically trigger capital gains in low income years, but because the taxation is ongoing, asset location becomes critical, meaning which types of investments you hold in which accounts. For example, keep higher growth tax efficient investments like equities or ETFs in your non-registered account. Avoid holding high interest TICs or bond funds here, as the interest is fully taxable. Your advisor should help you align your investments across accounts to minimize tax across your whole portfolio, not just within each individual account. What about corporate accounts? If you're a business owner or incorporated professional, you may have retained earnings inside a corporation or holding company. These accounts offer lower tax rates on active business income, typically between 9 to 12%, depending on your province. The ability to control when and how income is withdrawn. Access to the capital dividend account, CDA, when life insurance is involved. The key benefit here is control. Unlike RRSP or pensions, corporate funds give you the power to defer income, pay yourself in dividends, income spent in retirement if shares are structured properly, fund life insurance, or create tax-efficient succession plans. But they also come with tax traps, particularly around passive investment income and integration with personal withdrawals. The solution is to create a clear plan that coordinates RRSP withdrawals, TFSA usage, dividend income from corporate structures, and the timing of any capital gains or redemptions. When coordinated properly, corporate funds can serve as a powerful bridge to retirement and a way to leave behind wealth to your family tax efficiently. The retirement number isn't just a dollar amount, it's a plan. So how much do you actually need to retire in Canada? It's not a one-size-fits-all answer. It depends on your lifestyle, your spending phases, your government benefits, and your asset mix, and most importantly, your withdrawal strategy. The real goal isn't just to hit a magic number. It's to create a sustainable, tax-efficient income plan that gives you confidence year after year through inflation, market shifts, and life changes. Because the truth is, 1 million poorly managed won't last, but 600,000 with the right strategy can provide decades of reliable income. If you're approaching retirement and want help figuring out your numbers, creating a real strategy, and avoiding costly tax mistakes, I invite you to book a free consultation with me. Click the link in the description or visit noaspro.ca to schedule a time. Let's build a plan that fits your life, not someone else's.